tell the audience about how you got started in real estate. All right, Moses and Rhett, welcome to the show.
Yeah, thanks for having
Thank
us.
you. Yeah, thanks for having us.
Want to get started? You guys are doing an awesome venture with ReSeed. I assume almost all my audience knows about you guys, but want to get a little bit of background on how you got started in the industry and kind of where you're at today. Moses, let's start with you on that.
Yeah, at the risk of boring you and your audience, I'll go through quickly. My name is Moses Kagan. Through Adaptive Realty, which is my current company, and a previous entity, have been renovating apartment buildings in Los Angeles since 2008. We've renovated in that time probably 110 buildings. Currently have about $200 million worth of apartment buildings here in LA, capitalized through various different entities. And we manage those, and then another, I don't know, $200 or $300 million worth of apartments for other people as well.
Cool. Rhett, I want to get kind of deeper into your background just because you're one of the few people that the more I get to know, the smarter I think you are. And so want to get back into kind of how you got started because you have a very different background than Moses.
Well, hopefully it's because your starting point wasn't too low to begin with. But,
I had the same experience with Rhett, by the way, Tanner.
Yeah.
So you're not alone.
Very rare.
and, that's what happens when you're from Alabama. People set a very low bar. So, yeah,
That's right.
yeah. Well, my wife went to Auburn, so we would beg to differ. But on to the background. So I've been in investing roles for a little over 20 years. So grew up in Alabama, as I said, went to school at Brown, did a short stint in consulting, and then had the good fortune of meeting an incredible entrepreneur by the name of Ken Polk, who runs a business called Arlington Family Offices, which happens to be, a supporter of our business. But I became partners with Ken in that business and was the CIO for 11 years. And so when I was there, we allocated to managers, but we also did direct investments. That was the first real experience that I had in real estate. We made investments in hotels. We made some investments in apartments, and then we also did some direct. We did some development, some fun stories around redeveloping and building a lake, and sold some assets to public companies. So very wide-ranging experience and a really good start on the investment side. I then went to work or found a long-short equity hedge fund with a guy by the name of Adam Weiss. Adam was the PM and the clear leader of the business, but I was the director of research. And there I got some experience on investing in REITs, but largely in just high-quality companies globally. So I went from there to another outsourced CIO where I became the managing partner. And that's really where I got to know Moses. And really, we spent, one of my colleagues, Laura, was with me in that venture. That's where the idea of ReSeed was born. We had a large pool of capital and going out and buying long duration real estate assets. And so I left that business in July of 22, took a little bit of time off, and then Moses and a few partners and I started ReSeed officially in March of this year.
So I think we'll spend a lot of time talking about ReSeed. I want to go back kind of how it's evolved kind of from inception to kind of what it is today, how you formulated the team. Let's go through that a little bit.
Yeah, so every business certainly evolves, but I would say the original business plan that Moses and I worked through, it really hasn't changed a ton. Laura, our partner, one of our partners in this business, said that more 40-year-olds should start businesses, and both Moses and I are in that category, and unfortunately at this point. And so, we had 20 years of experience to draw on when we were designing this business model. And so, ultimately through his experience as a direct operator and then my experience on the allocation side and some direct investment experience, we saw, an opening in the market where there were a lot of very talented operating partners that understood real estate, but they didn't necessarily know how to take that first step and or how to scale an asset management business. Because oftentimes those that are great at identifying real estate, underwriting real estate, it may not be their core skill set to grow one of those businesses. And so if you were to look at the original business plan, what we've executed on is largely in place today. So, but I don't know if there's
let me just add to that. I mean, I think, as you know, Tanner, we've had the experience of building one of these real estate operating platforms from scratch, and experiencing an enormous amount of pain in doing so, mostly self-inflicted, just through a series of kind of mistakes and things we could have done better and all kinds of stuff. I mean, as an example, I think we renovated 30 buildings for other people on a fee basis, purely because we needed the cash, where we got no equity. Like, don't do that. If you're all listening, if you guys are operators, like, terrible idea. I mean, we did it because we had to, but in retrospect, it was not the right move. So, but we've got ourselves through trial and error and some luck and some content marketing, which we will, I'm sure, talk about later, got ourselves into this enviable position where we have a capital base of investors who are sort of bought into our vision of long-term ownership of high-quality assets. And for reasons that we'll get into, I'm sure, in a moment, that turns out to be a very good strategy for building a durable real estate asset management business. And so from my perspective, when Rhett came to me with the business model for ReSeed, what immediately jumped out was like, look, here's a way that we can sort of replicate the enviable situation that we've managed to get ourselves into an adaptive for these younger operators. And that just means that for them, it's taking away a lot of the trial and error and the mistakes and everything. And it's just saying, look, like, here's a goal we're going to point you towards, and we're going to give you a playbook and some capital to execute on it. And we can't know in advance how quickly you're going to get where we want you to go, because that depends on the market and luck and their ability to execute and everything. But we're very confident that if you set the North Star that we're asking you to set and you execute against the playbook that we're giving you, you're going to end up building a reasonable size asset manager, hopefully much bigger than the one we've built. But in any event, like, we've raised the odds of success dramatically, I think. And that's what appealed to me about the model to begin with.
And going back to some of the content marketing, one of my favorites, I don't know if it was on the blog post or something on LinkedIn or Twitter, but you have a series called Riding in the Clown Car, or lessons learned in the clown car from mistakes that you've made. And on a different podcast, you guys talked about kind of a checklist that you have for other operators, for ReSeed cohort members, kind of going through, some of the list of, mistakes that you have made. Like, for example, one of them was, go there at night and make sure that there are not, members of gangs hanging outside the building. Can you talk a little bit more about kind of the lessons that you've learned and how you plan to implement them with the cohort?
Yeah, I mean, and there's sort of two different sets of lessons. Let's say there's at the asset level, there's a whole list of mistakes that we've made, which we try to avoid now, and which we are trying to help our operators avoid. And that's stuff like go at night. Another one is, if you're underwriting rents that are based on some of the apartments having really excellent views, probably go check on the zoning of the lots that are in front of those views to make sure that no one's going to go build a big building that takes away your views, right? Like, there's and it goes on and on and on. And they some of them sound kind of trivial, but they're all just like mistakes that we've made and ones that can really screw up your deal. And over time, as you make more of them and your list gets longer, you're kind of reducing the surface area of mistakes that you can make. So that's one thing to say. That, and there's that's at the that's diligence at the asset level, but there are a whole other set of decisions that an operator makes around building a business. Okay, that have nothing to do ostensibly with like the assets involved, but have to do with like the strategy, how you structure the business, the terms on which you raise money, who gets decision-making rights, all these things that, we had to learn by trial and error, but there are definitely things there are mistakes that you can make you want to avoid. I'll give you an example from that list I put online. My brother and I started Better Dwellings, which was our original entity, and it was 50-50. The decision-making was 50-50, and the decision-making, we were both managers. And what that meant was there was no, when we had disagreements about how to proceed, there was no tiebreaker. There was no, like, it was just so even small disagreements ended up turning into like long-term, painful, months-long arguments. And that's a kind of a decision that oftentimes people will just like gloss over. Their lawyer says like, okay, who's going to be decision makers? And you say, we both are, and then you move on. And it's like you're sowing the seeds for a ton of problems later on. So what we're trying to do at ReSeed is address both levels, both like mistakes that you can make at the asset level, but also the kind of mistakes that you can make at the platform level.
And with that, I'd add a couple of things. I think, Moses has been very humble. He's talked about mistakes, but there's obviously, he's had, and other members of our team have had a lot of success as well, right? And so there's learning from failure, there's learning from success, and then there's learning from each other in the community. And so I think we should talk about this at some point. Like, we certainly believe that our experience is relevant and helpful, and as Moses pointed out earlier, we think we're shifting the probability that each one of these operators is successful, as a result of some of our experiences. But we also intentionally designed the cohort to learn from each other, right? And so that's a big part of shifting the eyes. To give you one example, we have one of our cohort members has done a lot of off-market acquisition and has spent a lot of time recently on the technology side. And I think what he is doing is very likely to be successful and transferable to everyone in the cohort, right? So there's kind of learning across a bunch of dimensions here.
Yeah, just to echo what Rhett said, and you probably, Tanner, experienced this yourself, like this can be like a fairly solitary business. Yes. You talk to contractors or brokers or whatever, but in general, you like don't want to talk to other operators in your area, in part because many of them are competitive with you. So it's hard to kind of open the kimono all the way because you're worried about, about competition. So putting these operators in a group of people who are walking exactly the same path, but in totally different markets, we suspect is going to have value. And we're already kind of seeing some of that knowledge transfer going on already.
And Rhett, I want to get into kind of how pitching this from the allocator's perspective. But first I want to get into, if you are, we'll say, a young and up and coming investment manager or broker or contractor, whatever your background is, why should someone join ReSeed? What do they get out of it? I mean, I obviously see all of the benefits because I've spent similar years kind of crawling through that glass that you've mentioned. But can you go into kind of the value that you guys bring to the platform?
Yeah, absolutely. And ReSeed isn't going to be for everyone, but we think the model really is suited for those that are contemplating starting a business or that have already started a business and are looking to scale the real estate operating platform. So you really think about the value is on the capital side, services that we provide, and then mentorship. We'll start at mentorship because we were already kind of in that thread earlier. So a lot of what we're doing is trying to transfer in the knowledge of what, as Moses said, his experience, my experience, Doug, partner and CFO, David, partner in the business, and Laura as well. And so, as you can imagine, let's just use some practical examples. I've probably been involved in setting up 12 to 15 different funds over the course of my career, right? At some point, every real estate operating partner is going to either set up a SPV to own a single asset and or set up a fund. And then Doug has probably done an equal amount in terms of establishing funds as well. And so what is the probability that we're going to be able to help you design a fund that meets the needs, your needs, but also your investors' needs, relative to if you were trying to do this on a standalone basis? And so I could probably give you 50 different examples where we have had a bunch of reps just in the nature of the businesses that we've been in, where it might be the real estate operating partner's first time. So we think there's a lot of value in the learning. There is on the services side, we're still pretty early days, but we've done some work around trying to drive down costs of technology, establishing partnerships on the accounting and tax side. We've built our own data sets and research processes that we provide. So, we certainly think that there's a lot of value there. And then on the capital side, what we're trying to do is, these businesses are very capital intensive, and it's hard to get them to cash flow break even if you're doing it from a standing start. And we've designed our program in a way that we think we reduce the duration that takes you to start to get to cash flow break even. And we do a lot of that because we provide operating capital, and we often will provide the co-GP capital when we're doing a deal. And so, once again, you can go from starting a business to getting cash flow positive very, very quickly. And if you look at what it would take without someone like us providing that capital, I mean, I don't know, Moses, if you have a view on this, but we think we can have folks that are cash flow break even in the first year versus, a multi-year, maybe up to a decade.
Yeah, I mean, let's. I just want to kind of unpack that a little bit. So, standard terms when you start doing deals is you have to put up a bunch of your own money as a GP co-invest, and that can vary. I mean, if you get lucky and you have understanding investors, maybe it's only 1% of the capital, but a standard might be 5 or 10% of the capital. And particularly in the beginning, your investors are going to say, well, we want you to have skin in the game, so we want you to put in more capital in terms of your co-invest than you're going to get out in terms of fees. And what that means is that you basically can't really adopt a long-term ownership model because you're from the perspective of the GP, you're cash flow negative on each deal. Like, you have to put in more than you're getting out, so you're depleting your bankroll. So however large your bankroll is, you'll do 2-3 deals, whatever, and you will have no bankroll anymore, and now you're stuck. And
I have unfortunately been in that situation. It's not fun.
Yeah, exactly. And then, and us too. And so what we're trying to say, that's exactly what we're trying to solve for at ReSeed, which is to say, look, we'll give you some money so you can actually, pay yourself a small salary, have some money to chase deals, for diligence expenses, et cetera. Then when you find a deal, if we like it, and we'll talk about in a second, what do we mean by we like it? But let's say we decide we like it. We will do up to 100% of the GP co-invest and up to 100% of the LP. And the operator gets to keep the lion's share of the fees. So what that does is it takes you from being cash flow negative as a GP on each deal that you do to being cash flow positive on each deal you do. In other words, each deal you do puts money into your bank account as opposed to depleting your bank account. And that means that you've got a scalable business, and that means you can focus on just going out and finding more deals and turning that crank as quickly as you can. Now, obviously, and we'll get into this, that creates some incentives that we have to be careful of. Like, of course, an unscrupulous GP would then, given the opportunity to flip a coin where they win on heads and they win on tails, is going to flip the coin as many times as they can. And it's kind of our job at ReSeed to make sure that we are vetting the deals and making sure that they are actually deals that we want to do. But assuming that we do our job at ReSeed, what we're doing is setting up a situation where the operators can sort of infinitely scale their business in a way that's sustainable. And that's just a very different situation from the one that most operators find themselves in, particularly early in their careers.
And you mentioned kind of avoiding those disincentives to do, bad deals. How do you think about that? Because like you said, if I go out and buy a deal, I get a asset management fee and my co-invest gets put up. I have all upside. So we'll pretend that I'm a member of the cohort in this example. I'm not, just to clarify. But how do you keep me in line with that? Like, how do you think about that?
Rhett, maybe I think the starting point here should be talking about our exercise of defining the buy boxes for each of the operators.
Yeah, absolutely. So, first of all, I think at a very high level in the asset management business, your reputation is everything. And so I think certainly Moses, with the restraint he showed over the last 24, 36 months, and that, the way that I've invested over my career, at the end of the day, that's the most powerful motivator for us not to do stupid deals, just to start with that. But what we did with each operator is we went through this process, as Moses said, called defining the buy box. And what we're doing is every market is different, and markets have different supply constraints and have different demand characteristics. And so at each market, we went and we said, okay, based on what we see in the market, what is the unlevered yield on cost that we would demand here in order to transact? And that, as you can imagine, there's different supply constraints in San Diego than Charlotte. And so therefore, we would demand a different price in different markets. And so we started there, but I think what's critical, and this is a big, in my mind, value add to those that end up investing with us, is we went and we had this document. It's called the underwriting guidelines. And so, as you know, there's a lot of places in real estate where people probably lie to themselves about what the actual cash flow of the assets are going to be, right? We think about how much CapEx an apartment is going to need over the course of a 10-year or 20-year hold. Oftentimes, if you have shorter hold periods, you may not fully incorporate that. So we have basically every major line item we've gone through and said, this is how you should think about it. This is the number. In the event that your underwriting deviates materially from this, you've got to provide us data. And then we've provided a model to each operator that Doug had built originally, our CFO. And so when we get a deal that's, we've already established the unlevered yield on cost by market, submarket. We've shown them how we expect things to be underwritten. And then we have the model, like that should all flow through. And it really eliminates a lot of the noise and the probability that you're going to have an operator something's going to show up on mine and Moses' desk and they think it's an 8, but it's really a 5. So that standardization is really, really important.
And I want to just echo that and say, we have, we've been pretty conservative over the last couple of years, as Rhett mentioned. And when I talk about that, we gave back that fund, et cetera. When I talk about that, people are often like, oh my God, like, how did you exercise so much discipline? And it's like, I can't emphasize enough that if you are really stringent about your underwriting, it actually does not require a lot of discipline. Like we have a buy box, we have a model, and we have underwriting guidelines. If you bring us a deal where the numbers, where you've correctly filled in the model according to our underwriting guidelines, and the numbers are in the buy box, like we're going to want to buy it, most likely, right? And if they're not, we're not going to want to buy it. So it removes like a lot of the emotion from the process. And we just need to be, as long as we're being intellectually honest, it should be pretty obvious to us what we do and don't do. And of course, like on the margin, there's some debate or whatever, but fundamentally, like it really, the goal is that the operator should never be surprised when we make a go, no-go decision.
Okay. And then kind of going back to the original cohort, like you said, everybody has these different backgrounds, and maybe they don't know what they don't know yet. Let's talk about who these operators are from a Cohort I perspective, and what you're excited about with that.
Moses, you may start.
Yeah, go for it.
So, as you mentioned, they're diverse in terms of their skill set, their background, and also the timeline in terms of starting their own business. So, we had over half the cohort that already had a business up and running. And that was a surprise. When we originally launched the program, we thought we would be helping people start businesses. It turns out there is a large group that had a business. Maybe they were approaching kind of a capital wall and that they had tapped out friends and family, or they just wanted to be associated with a platform where it wasn't a solo endeavor. It was something they felt like we could help them grow. But so just defining the folks in the cohort. So we have a number of people that have come out of traditional real estate, private equity backgrounds. So folks that were sitting either in an allocator seat, firms like Lone Star, et cetera, or they're in large real estate JV operators. And so, very traditionally trained, very deep underwriting expertise, but where we can hopefully help them on the capital side, as well as maybe even some of the nitty gritty of construction and property management. We have other operators that have come out of the property management business or own a property management business today. We have some folks that have come out of debt origination businesses, which we really like that background, especially if you've seen some stress and you understand. I mean, the last 10 years, we haven't seen a lot of stress. We think we're going into an environment where you're going to see a lot of stress. And so having those scars could be really valuable.
And let me just add, I mean, stepping back. So this is, I think, one of the reasons that Rhett wanted me involved in the company. First of all, we tweeted about the program and got, I think it was like 2,000 indications of interest from prospective operators. And I think we ended up with 650 or 700 completed applications. So we had a pretty broad universe to pick from. But, what we're doing is a new thing. And so we did not have like a absolutely like hard and fast set of criteria for selecting these people. What we do know is that successfully building one of these businesses requires two kinds of skills, two like broad buckets of skills. One is like the kind of stuff that you would learn at a traditional asset management firm, right? Like how to underwrite, how to read an operating agreement, basics of real estate finance, the kind of stuff that you would get trained on at Blackstone or any other like institutional real estate shop. So that's very important. However, particularly in the sub-institutional space, there's this whole other set of skills which are also extremely valuable, and those I would title that bucket like scrappiness, like just like being commercial. Like how do you, you've got a deal that you're looking at and it needs a ton of renovation, but you're not going to call up the most expensive institutional contractor in the market who's used to building 300-unit apartment complexes. You need to get the renovation done cheaply, right? How do you find a GC who can renovate a 14-unit building, right? They don't teach you that at Blackstone, right? Like one way we did it is drive around to a bunch of houses that were being flipped and literally walk into the doors of them, ask the guy on the construction site if we can meet the GC, and then meet enough of them and get comfortable with one of them and let them have a shot at renovating a larger building, right? Like there's a kind of like a just like scrappiness, like, okay, this is a problem and it needs to get solved and no one is handing me the solution set. So I got to go figure it out. And so the question is like, how do you find groups for the cohort that combine those vastly disparate skill sets, right? And we had some hypotheses about who those people might be. but particularly because we're intending to do many cohorts, it was important for this first one that we like test those hypotheses. Like, let's take some people from backgrounds that, you know, they look good, but maybe they are over-indexed on the scrappiness, and we feel like we're going to have to teach them on some traditional real estate finance stuff, or vice versa. But like, let's try to get a broad cohort so we kind of see what kinds of people work well for this, so that in subsequent cohorts we can kind of narrow our focus a little bit.
And on that note, you mentioned in a previous episode that you had kind of a grading score for these operators. How did that work out, and how do you think that's going to look in the future when you're, you know, onboarding or potentially onboarding future operators?
Yeah. So, I mean, we obviously don't know how good we were at it, right? This early in the process, but a lot of what we're trying to do is create data and that, and it wasn't, and just like most investment activities, it's not a black or white exercise. It's just, you're just saying, okay, how do I want to articulate my thoughts on, and then establish a process that we can evaluate on a post-mortem basis our decision making. And so we did come up with a scorecard, and it's a bunch, some of the items that Moses mentioned. We had a few items that were kind of no-go, like, you know, have you committed fraud, right? Like, we had some of these kind of basic high-level items that automatically kick folks out. But largely what we're trying to do, as I said, is create data so that in the future, we'll have a reference set to look at, to then be able to really hone in on what are those characteristics that we need to find that are highly likely to create a successful outcome.
And you mentioned one of the kind of plans for the cohort members is to build their own standalone real estate operating company. How do you think about that as, you know, we'll go back and say that I'm a member of the cohort, quote. You know, I'm getting LP money from you guys for, you know, 4 or 5 years, and those are the only deals that I'm doing. How do you think about expanding their capital moving forward?
Yeah, I mean, the answer is that real estate is an enormously capital intensive business. If things are going well, we would hope to be able to provide at least 51% of the capital for all their deals going forward, assuming those deals fit our criteria. First of all, if they're doing really well, that 49% leaves plenty of room to build a capital base separate from us. Separately, to the extent that they build, you know, a really great track record, and they're in a position, for example, to raise LP money at terms that are like better than what we would be willing to give them, like, they should go with God, like, and do it. I mean, that is from our perspective, that scenario is so good. We're so far into the win there that we're happy for them to do that.
Yeah. The only thing I'd add is that I think the natural evolution here, there's probably, this is going to be a little bit absolutist, but let's use 2 examples. You've got, somebody that just loves doing just sharpshooter, wants to do great deals. It does 1 or 2 deals a year. Occasionally it goes a year without doing a deal, but very high yields. That person, we probably will provide most of their capital for the duration, right? It makes sense from both sides. There's another scenario where it's someone that maybe they've come out of the institutional world. They want to start in the sub-institutional, and they really want to scale the business. In that case, we're probably most of the capital in the first, the early years. And then if they want to go up market and buy, a $100 million deal, maybe we will continue to provide the co-GP capital. But as we all know, yields tend to compress at that end of the market unless you have a giant distress cycle. So therefore, we're much more likely to be just the GP, and they're going to be able to raise the LP capital. And so, as Moses said, we're incented to help them grow the business. And we're also going to be rational and practical, and that we know they need to build that fundraising muscle. And so we're giving them opportunities to do that along the way.
And Moses, you are, I'm going to say, famous for your investment strategy on, very, very long-term holds. how does that work if, I bring you a deal and I say, I only want to hold this for 7 to 10 years? How does the capital kind of work alongside with that? How do you think about that?
Yeah, I mean, well, the first thing to say is that we really do want the operators to be selecting deals that they would be comfortable holding for longer than that. So we've been maybe simplifying things a little bit for the purposes of this discussion by talking primarily in terms of an unlevered yield on cost target. And like that's, I would say, by far our most important quantitative factor. But there are a whole range of qualitative factors that go into determining whether you would like to own a building for a long time. Like fundamentally, it's like the things that humans want are like pretty lindy. Like people have always wanted big windows and high ceilings and private outdoor space. Like that stuff doesn't change. And I don't expect that it's going to change over the next 10, 20, 30 years either. So in addition to those, to the quantitative targets, that we're looking for operators who are looking for buildings that have, for lack of a better word, like good bones, right? So if you came to me and you said, look, I've got a building that I think if you came to us with a building that met our criteria with like an unlevered yield that's good and good bones, like we're probably going to be saying to you, why would you hold that for 7 to 10 years? And what we're going to do, in other words, why wouldn't you hold that for longer? And what we're going to do is craft an economic structure for you as the GP that allows you to crystallize the value that you have created for the investors via your renovation and leasing program, but also allows our capital and you to own the thing and collect passive income from it indefinitely.
Can you explain the crystallization of a deal?
Yeah, I mean, look, at a high level, the idea is you have a operator buys a screwed up building and over the course of a year or two or maybe 3 fixes it up. Okay. And then thereafter you get a nice building that ought to just be that ought to just spit out cash, right? With some periodic updates. So what we want to do is create a mechanism in the operating agreement that says, look, after your stabilization program is complete, let's go take a look at how much value you've actually created. In other words, let's compare how much capital you've put into the deal to how much the property would be worth on the open market if we were to sell it. And then we sort of can run like effectively like a sale, like a notional sale, and say, look, we all agree that if we sold this thing in the open market right now, it'd sell at a 5 cap or a 5.5 cap or whatever the number is. Okay, let's run it. Let's run the waterfall. Let's see who would get how much cash, right? Based on the sale. Only we're not going to sell it. Instead, we're going to allocate ownership, like real, actual ownership, to everyone in accordance with the amount of cash that they would have got in the event that we actually did sell it. And so, depending on how well the GP did in terms of adding value, and also, of course, how things that the GP can't control, like the rental market and interest rates and cap rates, how much value is created. And then the GP is going to end up owning whatever it is, 7%, 12%, 15%, whatever that number ends up being of the building. And thereafter, the GP is effectively just like it. There's no more pref and promote. There's just an ownership percentage, and the GP is just getting cash flow distributions in the same way that any other investor in the deal would get them. And the idea
sounds really nice.
Yeah. Then the idea is that over time, if you imagine from the GP's perspective, right, you do a deal, you get fees, someone else puts up your co-invest, the promote gets crystallized, you end up owning 7% or 12% or whatever it is of deal A. Then you do deal B and C and D. And over time, you're earning fees, which are allowing you to live and grow your operation. And you are adding to your balance sheet these minority control positions in each of these deals, in deals A, B, C, and D. And therefore you're building up passive income from your stakes in those buildings. That is a business that is scalable and durable. Right. You do that for 10 years or 15 years, you're going to end up being pretty rich. How rich you are will depend on, how many times you can turn the crank and how the market performs and everything. But like, you're probably going to get rich.
I would assume so as well. Rhett, how does that work from a allocator's perspective? Let's say I'm a rich doctor who follows you guys on Twitter and I want to invest alongside these operators. How does that work for them?
So everything that we're doing is very long-term in nature. So just start with that. And so in the event that somebody is looking to make an investment and then get all their capital back in 2 years, we're not going to be a fit. So it's got to be somebody that wants to hold assets for the long term. But much like Moses has done, if you think about it, what we're doing is we're buying an asset. The cash flow profile during the value add period is pretty thin, right? You don't have a ton of yield. Once you stabilize it, you start to generate pretty significant yield. And then hopefully you have the opportunity to return capital through a refinance. So at some point throughout the deal, you actually get all of your capital back, assuming it goes well. But then you've got this residual and a good asset that we think we can hold for very long periods of time. So I would say that for our model, we're trying to find investors that are comfortable thinking in 10 and 20 year increments and that recognize that they're going to get all their capital back through yield and refinancing as opposed to a sale and paying taxes, kind of an driven.
And I want to segue this into Moses, your Twitter platform and just the following that you've accumulated. I want to start out by talking about Seth Godin and how he's influenced you, because I was on a call with Rhett a couple weeks ago and he mentioned how many people reached out in interest of investing alongside these operators. And it just blows my mind to think that you got this from a silly little social media app. So talk about Seth Godin, how he's influenced you and kind of how you've maintained that brand that you've built.
Yeah. So I guess for people who don't know, Seth Godin is I would call him like a marketing genius. The truth is this is going to be embarrassing, but I actually have only read one of his books, but it turned out to be a book that like completely changed my life. I should have brought it out. It's sitting on my bookshelf over there. The book's called Permission Marketing, and I ran across it at a very formative part of my career when I was just starting to have to raise capital from someone besides my best friend from high school, and did not have. I had started my career in London, moved to LA, didn't really have much of a network, and I had the ability because my friend had backed us for a bunch of deals. I knew how to identify a deal. I knew how to execute a value add program. So I knew what I was doing, but we had not developed any kind of fundraising muscle. We were like, imagine a bodybuilder who's super strong on everything besides his left arm. It's like totally worthless because you can't lift any weight, right? So I come across this book, Permission Marketing, and basically the point of it is that traditional advertising, traditional marketing was like you pay your beer company and you pay the NBA or whatever, NBC, for the right to interrupt a basketball game and show them a beer commercial to the audience. And from the audience perspective, it's like the advertising. I mean, yeah, maybe it's sometimes funny or whatever, but for the most part, it's basically just like a tax on your a cost that you pay to watch the basketball game. I'm gonna have to watch these shitty car commercials or beer commercials or whatever. And Godin's like, look, with the internet, you can have bidirectional communication. So instead of interrupting and upsetting the audience, instead put out very valuable educational content to them. In return, ask only for permission to continue to educate them. Right? And in this case, that can be something as low value as a Twitter follow or a LinkedIn follow, or it could be something as high value as an email address. But fundamentally, it should be conceived of as permission to continue to contact them. And then over time, you continue to educate them for free, asking nothing, just teaching, providing lots and lots of value. And then at some point down the road, when you actually want something for them, in this case, from my perspective, it would be investment in a deal. When you're coming to them and saying, hey, would you invest in my deal? It's not like some cold call or a salesman knocking on your door and trying to sell you something. It's like someone who you already know and trust because you've been reading their educational content sometimes for years, coming and saying, hey, you think I'm smart. I'm putting my reputation on the line to do this thing, buy this building, start ReSeed, start reconvene the conference we run. Like, would you like to be a part of that? And the answer in that scenario is very often going to be yes, because I already trust you. So that's basically Seth Godin in a nutshell.
And how do you think about providing, you've provided such in-depth educational content over the years. How do you think about, creating value for your target audience who is, a rich passive investor, but you're giving a lot of value to kind of your competition at the end of the day? How do you think about that?
Yeah, I mean, the first thing to say is while passive investors are obviously a major portion of the audience that I seek to address, they are not the only one. I didn't have a mentor. Like all this thing that we built was like me and my partner knowing that we wanted to build one of these kind of businesses and not really knowing how to do it. And it's a little tough to remember, but like 15 years ago, there weren't like all these resources available. There weren't these podcasts. There wasn't real estate Twitter. So it was like, you'd find a book. Like I found this book, Multifamily Millions, that sort of described a lot of what we did. And it was, oh my God, this is a shitty book. Like it's so scammy. The guy's trying to sell you conferences and like, whatever. But like, you're like, oh, this actually seems to talk to what I want to do. And it was like, that was like gold because there was so little of it. So I was like stitching together how to do this from like random pieces of content that someone would write a Wall Street Journal article about a beginning hedge fund. And I would be like, oh, there's such a thing as placement agents. Like, I didn't know there was a placement agent. Like, you know what I mean? Like I was just stitching this stuff together from things that I read and people that I talked to. So a big part, I have a lot of empathy for that person, for who I was 10 or 15 years ago. And so I know exactly what that person is wrestling with in terms of what sorts of deals to do, what asset class, what strategy, how do you think about building a firm that it coheres with the strategy? Like, who should you hire, when, all those things. Like, I remember viscerally having to make those decisions and not having a lot of guidance. And so, I like to teach, and a large part of what I'm doing is sort of saying to that person, like, here's how to think about that, or here's how I would think about these problems that you have. And I enjoy that separately from it turns out that if you do that, a bunch of passive LPs reading along are like, hey, that guy's pretty smart about doing real estate deals and I would like to invest with him. Right. So that's kind of how the cycle works.
Yes, I can't thank you enough for the blog post that you did. One of my favorite blog posts that you've ever done. I can't believe that you did this, by the way. It's awesome. But you had a percentage of your fund and who invested. And it was the coolest thing I've ever seen, which makes me sound so boring. But I just want to thank you again for that.
I forgot about that, but until I remembered it now that you mentioned it. It was like, this guy was my friend from Andover and this guy was my friend's mother. And yeah.
It's so cool because from my perspective, it's like, I've said it's hard to learn real estate unless you had a PhD. And like the PhD stands for Papa Had a Development Company. And unless you know someone firsthand on like a really good relationship, whether it's like your uncle, your father, your brother, your sister, your aunt, whoever it was, it is so hard to find the little minute details. For example, I was trying to put in a mailbox at one of my properties. I could not find it on the internet. So I had to call one of my friends and she told me to call the postmaster. Like, who's the postmaster?
I know that problem very well.
Yes. So I've been there. I want to talk about the future of ReSeed. Rhett, what does that look like in the next coming years? I mean, I'm sure that it's been a daunting task to onboard Cohort I because they're learning stuff and you are also learning stuff. What does the future of ReSeed look like in the next 2 years and 20 years?
Yeah. So I don't think the business will look much different in terms of what we're doing. Just the question is at what scale. So we had the first cohort to Boulder in August. As we mentioned, there's 8 groups in that cohort. We plan on doing a second cohort sometime middle of next year. That's largely going to we'll have to be industrial and some multifamily. Again, the first cohort is all multifamily. And then we haven't said when we're going to do the third cohort, because a big part of what we are doing is providing capital to these operating partners. And until we have a baseline of like what the capital needs are going to be, we want to make sure that we can deliver on our promise. So the pacing of when we roll out cohorts is kind of TBD and to different asset classes. And we just want to continue to support operators and provide capital from long-term investors. So largely the same mission.
And why industrial for the next cohort? I mean, I'm a little biased, but I think it's great.
Well, Moses has his own response and experience to that, but I do think there's a fair amount of commonality in terms of the underwriting and how you think about it. You remember, I'm a business analyst at my core, and so I think a lot about cash conversion and what the return on invested capital. And as you know, Tanner, there's just not as much CapEx in that business as there are in a lot of the other real estate asset classes. And we all know kind of the supply story in terms of it's not a lot of Class B industrial that's going to be created. And we know the demand story on with kind of the internet penetration. So very, very attractive and the logical next step, although we don't, ReSeed will continue to expand, but the pace at which we expand other asset classes is definitely TBD.
Moses, is there anything you want to add on that?
Well, one thing I want to say is that we're very specifically talking about multi-tenant industrial, not single tenant. That's like and I think you'd say that infill multi-tenant industrial is probably as close as you can come to multifamily. At least I think that's true. It's about as close as you come to multifamily, and still, at least in my market, dodge some of the regulatory issues that are coming down the pike or have already here and probably coming down the pike in fuller force for multifamily. But in terms of relying on like a large diverse tenant base instead of on the credit quality of any one particular tenant, and therefore not having like binary vacancy risk and having sort of fungible tenants, it kind of feels a lot like I think it operates a lot like.
It's just a better version of multifamily, in my opinion, because it's triple net leases, and I don't care if a toilet gets.
Yeah, I mean, I think that the reason. I mean, I'll just be really candid. The reason that what is holding me back, like I love almost everything that I know about the multi-tenant industrial space. What is holding me back from jumping in with both feet, and I think Rhett probably would agree, is that the kind of small businesses that tend to be your tenants in assets like that are going to be cyclical businesses, and there's no credit quality, right? Like you're like, it's like a guy, a guy who's making cabinets or cutting countertops or whatever, and those are great businesses, and the good news is, or they're fine businesses, and the good news is if one of them fails, notionally there ought to be another one who will step in and take his place, but they are all cyclical and tied to the economic cycle, and we are, I believe, at the tail end of probably like the longest boom, and at least in living memory, and maybe in like modern American history. So I'm a little concerned that what looks like a non-cyclical business is actually quite cyclical. We just haven't seen a cycle in a while. And so that's the thing that's giving me pause. But like at a certain basis, like I would definitely do it now. And particularly if we start to see a downturn and we start to see vacancy increasing and rents falling in that asset class, then for sure I'm interested.
That's an interesting point that you brought up just barely regarding when rents start declining, or I'm going to say when, not if. Rents start declining, vacancy starts increasing. Everybody's going to be running the other direction, saying, I don't want to buy anything. We're all toast. Like, this is the end of the world. How do you go about telling your audience or telling your following or your investors, now is actually the best time to buy?
Two things to say. One is, the beautiful thing about content marketing is that you attract people who think the way that you do. So like, I got a bunch of value investors on my email address, like on my email list. Like they're all like reversion to the mean, counter-cyclical type people, like in their bones anyway. So it's not like this is like a hard sell, right? Like they're like, yes, that sounds like something we would want to do. So that's the first thing. The other thing to say is, I've made a point of not, let me tell you a story. Early on in my career, we'd probably already bought, I don't know, maybe 4 or 5 deals. And we were looking at a deal it was a bank-owned triplex. And it was, the broker approached me and he was just like, look, this deal is really, really good. Like, you should do this. And I'm like, I'm feeling like we had just had some problems with the tenant buyout at a different deal. And I wasn't excited to do more tenant buyouts. And the guy was just like, if you don't buy this deal, I'm going to buy it. Like, he basically like did everything besides like grab me by the lapels and be like, you have to buy this deal. And I did it. And lo and behold, it turned out to be a spectacular deal. But you don't get to do that more than once with someone. You know what I mean? Like you can, so you don't do that. You don't hard sell someone unless you really know that it is a home run, spectacular thing to do. And so what I've done is consciously avoided grabbing anyone by the lapels now for like probably 4 years, knowing that there will come a time again where I will want to grab people by the lapels, and I'm not going to want to have burned my credibility getting them to do sort of mediocre stuff in the interim.
Yeah. And how the
Rhett, is there? Yeah, I was going that way anyways.
So there's a couple of things to think about here that I think are really relevant. One is, as you said, oftentimes when markets get scary, people start running for the hills. But this is where our philosophy really, we should be at a strategic advantage. For the past 36 months, if you've been a largely, oftentimes a cash buyer, an absolute yield buyer, and not a spread buyer, you've been at a disadvantage. In markets where there's the forward operating environment is cloudy, those that are well capitalized and have longer duration are a significant advantage, right? So if you think about it, if in the event that we buy a deal all cash and the next 12 months rents go down 5 or 10%, it's not good, but we will be fine. If you buy a deal with 70% leverage and rents go down 5 or 10%, and you have a business plan that's 3 to 5 years long, you're in real trouble, right? And so for us, it's, what we're thinking about is how do we properly capitalize assets so that volatility is our friend and that we really use our, main advantage, which is duration of capital. And so if you just think about those operating environments and the distribution of returns in those environments, that's when we really should be an advantage.
And do you think there's any difference with, you're pitching larger, quote, more sophisticated, end quote, allocators? Is there really any difference between the way that they think versus, the wealthy small business owner? Are you pitching them in any different way?
That's an interesting question.
Yeah, I have
only the finest here.
I have a hard time with the generalization because I would say that certainly at the very high end of kind of the institutional world, it's largely very sophisticated. But we have had interactions with people that are going to write certainly not 7-figure checks, 6-figure checks and deals that are incredibly sophisticated. And then we obviously have some institutional investors that I would label as very, very, very sophisticated as well. So I don't think asset size, maybe there's some correlation to sophistication and the way you pitch them, but our message is going to be consistent and the same. And hopefully, as Moses said, we'll just attract the right audience.
And I would let me just add something else. Like, one of the largest sources of capital for Adaptive for my company has been partners in VC or private equity firms investing their own capital, right? So these people are as sophisticated as it gets in terms of thinking about IRR, and they raise institutional capital in large sizes, and then they're with their own personal money, they're opting for a long-term, patient, low leverage, conservative, long-term compounding type strategy. And so I almost think of it as almost like a horseshoe. In other words, that in some ways, they are thinking about things the same way that an immigrant family that buys a duplex and rents it out and doesn't sell it, that they're thinking about it. Real estate is the kind of, particularly multifamily real estate and arguably multi-tenant industrial real estate, the way we talk about it, these are assets that are very, very durable. They are good sources of cash flow. What screws them up is people over-levering them or buying them with equity that has short duration. So what we're saying is just don't do that. Buy good stuff and set up your capital in a way that allows you to hold it long-term. And it turns out that it's a horseshoe. The immigrant family and the PE fund partner, they think about it the same way. It's the short-termist thinking is being, we haven't really talked about it, but the short-termist thinking is being driven by a specific set of incentives that exist in the real estate private equity business that are being driven by non-tax paying institutional investors. That's where that short-termism is coming from. So all we're saying is look, fine, that's a fine business model, but we don't want to be part of it, or whatever. I mean, it's fine for what it is. We don't want to be part of it. We just want to own good stuff long-term. And there are plenty of smaller, but also larger investors who think about things the same way.
Yeah, maybe the last thing I'll add is I think we're probably solving slightly different problems for different capital bases, right? So if you think about large multifamily offices that are sophisticated and have a staff, what we're doing is we're providing them a highly curated deal flow that they can scale their program, right? Whereas someone that may, has a day job and wants to do some real estate investing on the side, we're also providing them curated deal flow, but they're probably going to build a more diversified portfolio with us, spread the bets, and it's not necessarily about scaling to some significant portfolio. It's having a trusted advocate that they know that has made sure that every deal that they're doing is one that's on a risk-adjusted basis attractive for their type of capital.
And if someone's listening to this right now and they say, I want to be a part of this as a limited partner, how do they go about that?
Yeah, step one is just go to the ReSeedPartners.com website, click the investors link, and go put their email address in, and we'll follow up. And we sort of do a questionnaire, and then we do some follow up either by email or phone call, and try to based on what your requirements are, how you think about the world. And by the way, there's some people who should not invest with us. And that's part of that pre-qualification process is that too. It's we want to make sure this is a very specific strategy, as Rhett said before. This is not for someone who wants their money back quickly. So we want to make sure we're effectively getting married to our LPs. So it's very important that everyone understands before the ceremony what the basis of the relationship is going to be. But the idea is go sign up on the website, and then we'll talk for a while and figure out if it makes sense. And then there's sort of a range of options for being involved at that.
Cool. I think let's leave it there. This has been awesome. Thanks, guys.
Thank you, Tanner.
Thanks, dude.